Most traders think trend lines are simple until they actually try to use them. Once you start analyzing the chart, confusion begins. Should I draw trend lines using wicks or candle bodies? Which time frame really matters? Should I trade the rejection or wait for the breakout? There is no single rule everyone follows. Everyone draws them differently, yet expects the same results. And today, I'll clear that confusion. Welcome to Graph Insight. In this video, we'll cover what a trend line actually is, how to draw it correctly, and which extra criteria I use to identify trend lines that are worth trading. Then, step by step, I'll break down the most profitable trend line setups that I've consistently used over the years. If this topic is useful to you, make sure to like the video and subscribe to the channel. Now let's get into it. First, let's define what a trend line actually is. A trend line is a line that connects consecutive swing highs or consecutive swing lows. It helps us identify the direction of the market, whether the trend is bullish or bearish. Swing highs and swing lows are key turning points on the chart. A swing high is a peak before price starts moving down. A swing low is a bottom before price starts moving up. For example, on this chart, we can see a series of consecutive swing highs. When we connect them with a line, we get a trend line. Each new swing high is lower than the previous one, which tells us that the market is in a downtrend. Now look at this example. Here we see consecutive swing lows forming. When we draw a line through them, it becomes clear that each new swing low is higher than the previous one. This tells us that the market is in an uptrend. At this point, you might think that you can identify the overall trend just by looking at the chart, and you would be right. But there's more to it. We don't draw trend lines just to label the trend. We draw them to track one of three possible scenarios, which we will later use to enter high probability trades. So, what are the possible scenarios? The first and most common scenario is a price reaction from the trend line. On this chart, we can see a series of consecutive swing lows, which form a clear ascending trend line. Price then pulls back toward the trend line and confirms the reaction by closing a bullish candle. This confirmation gives us a valid opportunity to enter a long position. The second scenario is less common, but often more powerful. It is a break of the trend line followed by a trend change. On this chart, we can see multiple swing highs forming a descending trend line. However, the next price move breaks this trend line with several strong bullish candles. After the breakout, price pulls back to the trend line, and at the end of the move, we see a bullish candle closing higher. This acts as confirmation that the trend has changed. This scenario signals a high probability of bullish continuation and gives us a valid long entry opportunity. The third scenario is manipulation in the form of a false breakout. On this chart, we can see multiple swing lows forming an ascending trend line. In this case, price breaks below the trend line, but instead of continuing lower, it quickly reverses and moves back in the direction of the original trend. This false breakout acts as a trap for breakout traders. These moves are designed to make traders believe that a real breakout has occurred, encouraging them to enter positions in the wrong direction. Once those trades are triggered, price reverses, leaving many traders stuck in losing positions. This is exactly why, in the first two scenarios, we never enter a trade without confirmation. However, even with confirmation, real market conditions are often more complex. In many cases, confirmation alone is not enough to ensure a high-quality trade. That's why we also need additional confluence before entering a position. We'll come back to those extra confirmations shortly. Now let's talk in more detail about how to draw trend lines correctly. First, a valid trend line needs at least 3 clear swing points. 2 swings are not enough to consider a trend line reliable. This is where many traders make their first mistake. Now, the most common question, should you draw trend lines using candle bodies or candle wicks? The answer is simple. You can use both. What matters is how many clean touch points you get in a specific scenario. For example, on this chart, when we draw the trend line using wicks, we get 5 clear touches. When we draw it using candle bodies, we only get 3. In this case, drawing the trend line using wicks makes more sense. On this chart, the situation is reversed. Using wicks gives us only 3 touch points, while using candle bodies gives us 4. So here, drawing the trend line using candle bodies is the better choice. The key idea is this. Always choose the option that gives you more meaningful reactions. At the same time, don't obsess over drawing a perfect line. Trend lines should be treated more like zones, not precise lines. Small deviations are normal. Now let's talk about time frames. There are no strict rules here. If you're trading short-term, like scalping or day trading, you'll naturally use lower time frames. If you're trading longer-term, like swing trading, you'll focus on higher time frames, and so on. The key idea is simple. Your trend lines should always be drawn on the same time frame you trade. Now that we understand how to draw trend lines correctly, let's move on to the first strategy I use. This is one of the approaches that has made me a lot of money over time. The first strategy is called the Trendline Confluence Setup. This strategy focuses on trading areas where a trend line aligns with a key support or resistance level. When these levels come together, they create an area of high confluence. This is a zone where many different traders are focused at the same time. Trendline traders, support and resistance traders, price action traders, and candlestick traders are all watching the same area. Because of that, the probability of a price reaction increases, giving us a high-quality trading opportunity. Now let's break this setup down step by step. On this chart, we can see a series of consecutive swing highs, which we use to draw a descending trend line. We can also see a support level that formed after multiple price reactions. Later, this level was broken and turned into resistance. Price then retraces back toward the trend line and reaches the area where the resistance level and the trend line intersect. At this stage, we do not enter the trade yet. We always wait for confirmation. The confirmation comes in the form of a bearish candle closing down, showing a clear rejection from this area. After the confirmation, we enter a short position. The stop loss is placed slightly above the confirmation candle. The take profit is set at 3 times the stop loss distance, giving us a 1-to-3 risk to reward ratio. This allows us to remain profitable over the long term, even with a win rate around 35 to 45%. Now let's look at a bullish scenario to complete the picture. On this chart, we can see multiple swing lows, which allow us to draw an ascending trend line. We can also identify a resistance level formed by several price rejections. Eventually, price breaks above this level, turning resistance into support. Price then pulls back and approaches the area where the new support level intersects with the ascending trend line. As you already know, we do not enter the trade immediately. We always wait for confirmation. In this case, the confirmation comes in the form of a bullish candle closing after price touches the confluence area. After the confirmation, we enter a long position. The stop loss is placed slightly below the confirmation candle. The take profit is set at 3 times the stop loss distance. Now I want to show you another strategy that I use, one that can potentially generate even more profit. In this strategy, we trade the trend line breakout. First, we need to identify a valid trend line. On this chart, we can see multiple swing highs forming a descending trend line. After that, price breaks above the trend line, which signals a potential trend reversal. To enter the trade, we wait for a retest. Now this part is important. Price does not always retest the trend line perfectly. In many cases, it doesn't touch the trend line at all before moving away. If we wait only for an exact touch of the trend line, we can easily miss a good entry. To avoid this, we mark a retest zone. The boundaries of this zone are defined by the candle that caused the breakout of the trend line. Instead of waiting for price to return to the trend line itself, we wait for price to return to this zone. As we can see, price retraces back into the retest zone and forms confirmation in the form of a strong bullish candle. At this point, we can enter a long position. The stop loss is placed at the lower boundary of the retest zone. For the take profit, I use the 2 nearest swing highs. I close half of the position at the first swing high and the second half at the next swing high. Once price reaches the first take profit, I move the stop loss closer, protecting the trade, and then wait for price to reach the second target. As we can see, price eventually reaches the second take profit. Even if price did not reach the second target, we would still remain in profit because the stop loss was already moved after the first target was hit. Thank you for watching. If this breakdown helped you see the market more clearly, make sure to like the video and subscribe to Graph Insight. Let me know in the comments which concept you want me to break down next. I'll see you in the next video.